All right. Today is Thursday, February 16th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight, and let's begin with this. In the last few days, the last few weeks, we've been talking about the mounting evidence that we have a case of rebounding inflation, and with that should come more interest rate hikes and more tightening of the monetary policy, which also means more downside for equities. The problem is, while we had, for example, gold responding to this case by reversing the rally year to date, while commodities responded to the data and went down, while bonds also responded and reversed the rally, it seems that every indicator is saying, okay, we know what's going on here, inflation is making a comeback, and therefore the Fed will have to come back with more aggression, yada, yada, yada. But absent from this rationale and receiving the memo is the equities market and the tulip market, aka the crypto market. And the slew of data, the mountain of evidence continued to pile in. We've been asking, what will it take for the equities market to finally receive the message? Data after data after data, suggesting rates will go higher. Equities should go down. The monkey rally doesn't make sense at all. But the crowd kept marching on, buying the dip over and over and over and over again. In other words, digging their graves over and over and over again. But today, something changed. Today, something broke. Today, the equities market said, okay, we get it now. We saw a stunning reversal by the end of the day. Now, a lot of observers will attribute the reversal to commentary by San Luis Fed President Jim Blaze, who set the market on fire. But was it Jim Blaze, really? Or was it the mechanics of the market? Was it something we talked about on Discord today? Or was it the market maker inducing maximum pain, which we talked about in last night's video? Which one is it? We're going to talk about all of it and then some. But before we start, I want to say something about our community here on YouTube. Today we got the news that the CEO of YouTube is resigning. I say good news, pop the champagne, because she was an absolute disaster to independent content creators. The algos were hostile toward us, favoring the trash from the mainstream media, shoving it down the throat of the viewer. All of the ad money was going to CNN and trash content nobody wants to watch. And I'm hoping and crossing my fingers that the new management will recognize that the bread and butter, the backbone of YouTube, is independent content creators, pouring their hearts out, spending a lot of time with very little resources, utilizing creativity to produce unique content, which is keeping the viewers coming back to YouTube. Not the trash from the mainstream media, but one can only hope. With that, folks, let's move on to the main segment of tonight's program. And here it is, in focus tonight. Rest in peace to the monkey rally. It was good while it lasted, but it was perhaps one of the dumbest rallies in stock market history. Today, something changed, folks. The narrative changed. It doesn't matter what the stock market is going to do tomorrow. It might close positive for all we know. It doesn't matter. Today, something broke. Today, the narrative changed. What are we talking about? We talked about the bullish argument, which is of two ways. Either the Fed is going to pivot because the economy is too weak, and we talked about how the slew of economic data, be it the jobs report, be it the hot CPI, and today the PPI, that route is now closed. The Fed is not going to pivot. That's over. And there was one route open for the bulls, which is the soft landing route. That okay, maybe the Fed is going to raise rates, but the economy will not be damaged, and everybody's going to live happily ever after. And of course, this was the catalyst for the monkey rally. Pivot optimism was the catalyst for last summer's rally. The soft landing is the catalyst for the monkey rally that we got so far this year. But today, even the soft landing route is now shut. It's over. It's done. Not going to happen. But of course, the bulls are now in the bargaining stage of grief. They're now in the back to normal stage in market psychology. And in this stage comes, well, bargaining. So if pivot is not going to happen, soft landing is not going to happen, they now have a new thesis, which is no landing, which is absolute stupidity. You know what no landing means? It means that we accept inflation as is, because by soft landing or hard landing, we're talking about bringing inflation down to 2%. Is it going to happen amicably with not a lot of damage happening in the economy? That is the soft landing. Or is it going to happen with a lot of damage to the economy? That is the hard landing thesis. So what is the no landing? It means accepting inflation inflation as is as 6+%, which is absolute lunacy. Not gonna happen. But why did the soft landing route shut close today? With the bulls and the chasers of the monkey rally finally getting convinced that this is not gonna happen and equities pricing will have to go down now that rates are gonna move higher. Well, today we got the PPI, the Producer Price Index, which is a leading indicator for the CPI, the Consumer Price Index. The headline reads, wholesale prices rose 0.7% in January, more than expected, fueling inflation increase. And this blew past expectations by a lot. Look at this. When imbecile Jerome Powell says that we have the disinflation process in the economy, what the hell are you talking about, fool? Look at this. Does this look like disinflation to you? Every single category, almost, lasted higher, back into positive inflation territory. If anything, we have a rebounding process of inflation. And folks, it gets worse. Listen to the conversation in Bloomberg and maybe you're going to catch it. Let's see if you can. Take a look.
Is this enough, Michael McKee, to say people underestimated the strength, underestimated the resilience, and that disinflation isn't happening nearly as much as people expected a month ago?
Well, it's not happening as fast as people expected. And I think that was the big takeaway from the numbers that we've gotten this week. People thought, given what we saw in November and December, that prices would come down very quickly. They're coming down, but not very quickly. Goods prices, remember the story was that goods prices were going away and services were the issue. 1.2% rise in goods prices in the PPI for final demand during the month of January, and services only up 0.4%. So the opposite of what we were looking for.
Did you hear that? Even goods inflation rebounded in a stunning fashion. In the last FOMC, Jerome Powell said, oh, we have a disinflation process in goods. We're just waiting for services. We now know that goods inflation is also rebounding higher. There is no disinflation. There will never be disinflation until the Fed takes charge. And by that, we mean raising rates above the rate of inflation to guide it down. That is the only way to defeat inflation.
And I got to mention, the PPI for trade services, which is basically, they calculated from the margins of retailers and wholesalers up only 0.2% after 0.8 the prior month. So what we're seeing is a compression in margins. And there's a story on the Bloomberg today about how in the past that's usually led to layoffs, which is not happening this time.
We got to get to Michelle Meyer with her wonderful view on the consumer. But Mike, I've got to ask you about the Fed speak today. Professor Rogoff sat in your chair 2 days ago and began to model out 6% yield structure. Bullard, who speaks today, shocked us with a 7% what if out a ways. Are we shifting up now? Are we going from a low 5-ish up to a higher view or guesstimate out?
But the problem with all of this, folks, it's not just that inflation is rebounding. It is the fact that stagflation is worsening in the economy. Stagflation happens when inflation sticks, but the pace of economic activities continues to slow down. What else did we get today? The answer is, how about the Philly Fed Manufacturing Index? And it continues to sink. This was the lowest reading since May 2020. So you have the economy collapsing as we speak right now, while inflation is rising higher again. The worst possible scenario. And on top of that, the Fed is going to raise interest rates under this environment. Oh boy, buckle up, brace for impact, because this economy is about to collapse. In reaction to the news that we got today, which is, by the way, on the heels of a hotter than expected CPI and a hotter than expected employment report and a hotter than expected wage inflation report, the zombies from the Fed came out. And this leads us to a segment we call Fed Zombie Alert. We begin from the city of Cleveland with the zombie mister, who, by the way, was laughing about when she was asked about, hey, are you guys now thinking about tapering and tightening the monetary policy now that inflation is moving higher? And she was laughing.
And yet inflation is running pretty hotter than most people expected and lasting longer than most people, including you guys at the Fed, expected. Have you stopped using the transitory word, or have you changed the way you've thought about how long and how persistent this is going to be in our economy?
Well, she's not laughing anymore. She's now actually becoming a hawk, saying that she saw a compelling case for half a point hike at the January meeting. We said in this channel, folks, that moving down from 50 to 25 basis points is premature. It's going to send the wrong signals to the market and the economy that the Fed is about to pivot, the Fed is about to cut rates, but of course leave it to genius Jerome Powell to up the job again. Mr. was not finished. She also added that the central bank has to be prepared to move interest rates higher if inflation remains stubbornly high. And speaking of high, we also got St. Louis Fed President Jim Blaze, who came out today and said he would not rule out supporting a 0.5 percentage point interest rate hike at the Fed's March meeting. And immediately, the odds for 50 basis points at the March meeting shot up higher. But again, was it really the commentary by Jim Blaze that lit up your calls on fire today? Because Mr. said the same thing earlier in the morning. Nothing happened. The dip buyers showed up and they bought the dip, putting their blindfolds on, running Naruto style, heads first, asking questions later, and buying the dip over and over and over again. Or was it a technical reason that we talked about in Discord, which is the algorithms tracking the dollar? Or was it the dealer, the market maker, saying, okay, thanks for playing, folks, but now I'm going to make sure that you're going to lose your money? I think it's a combination of all of the above. But look at this. The market expectations for the terminal policy rate went higher from about 5% to now 5.25%. And next thing you know, 5.5%, and then 6%, and then 6.5%, and then 7%, 7.5%, 8%, until the entire economy blows up. And folks, so far we talked about stagflation. We have one side that suggests more inflation to come, the PPI, and then we have another side showing weakening in the economy, and that is coming from the Philly Fed Manufacturing Index. But on top of that, today we got perhaps the most horrific piece of data suggesting that this time around, when the economy blows up, not if, but when, it is going to be one of the biggest you've ever seen in your lifetime. Why do we say that? Rates are going higher. No doubt about it. The bond market is saying that. The commodities market is saying that. The Fed is now saying that. And even the equities market is now buying the argument of all rates are going to go higher. What is the impact and the risk of rates going higher? If you watched last night's program, you know exactly why. The level of debt is rising higher and higher and higher. And with higher rates comes the risk of defaults and things blowing up. And today we got a shocking piece of data from the New York Fed. Household debt rose by $394 billion in the last quarter. This is the largest increase in 20 years.
Oh my God!
Nothing to see here. What can go wrong here, folks? The economy's fine. We have a soft landing coming. Only debt is rising and rates are going higher too. The combination of both means more bankruptcy, more delinquencies, and more defaults. Matter of fact, consumer debt now hitting a record of $16.9 trillion, and delinquencies are rising as well. Uh-oh. And I know what you're going to say. You're going to say, Maverick, we get it. The stock market is going to go down now because rates are going higher, inflation is coming back. You were right all along. But what do we do now? Where do we park our money? A lot of places, including equities, by the way. But you got to be picky. But if you don't want to take the risk, look at the risk-free market, for example. You got the 6-month treasury paying almost as much as the S&P 500. Now, a lot of you money managers watching the program tonight, why not park your clients' money in some T-bills? Get them 5%, 6%. When the market goes down yet another 10, 15%, and your clients made 5, 6% risk-free, you're going to feel pretty good. Your clients are going to feel pretty good. And folks, before we move on to the stock market segment, the signs were already there. The leading indicators were already there that the monkey rally is about to frizzle out and move down in the most violent fashion you're gonna see. Why do we say that? This is what I posted on Discord yesterday, not today. I said that the market continues to algorithmically follow the dollar tick by tick, indicating low volume. If that is the case, we know who will win the tick by tick battle. If you read my morning brief, we have to assess the quality of the market using two categories: high quality and low quality. In my morning brief, high quality is considered chips, energy, and tech. We're talking about mega cap tech. We're not talking about the speculative names. In the examples I gave in the morning, high quality is down overall. In chips, AMD and Micron still not catching enough of a bid. In energy, Valero, Coterra are down. In tech, CRM, Salesforce, and Amazon are struggling to catch a bid. In other words, high quality is not leading the market right now. And remember, chips led the monkey rally. And this is really important. I'm going to show you that in a minute. But I also said in my post, on the other hand, low quality is, meaning leading the rally. High beta examples I gave, such as Stitch Fix and Peloton, are all up big. And momentum examples, such as Spotify and Tesla, are catching a bid. These are considered low quality because they're moving higher based on a gamma squeeze. The difference between the earlier stages of the rally is that high quality was participating. Not the case anymore. Furthermore, every bear market rally in the Qs ended by marking a gap higher, followed by consolidation phase in which high quality stops participating while low quality continues to perform, only to be followed by the next stage, which is the end of the rally. And today, I issued another morning brief. You can pause it and look at it. But in summary, I said that low quality continues to lead, high quality is not leading anymore. We also have important options expiration. We know what the dealer is going to do. The dealer is looking for maximum pain. We look at the recent speculative names such as AMC, for example. The maximum pain point was $5. For Tesla, it was $200. For Carvana, it was $10. Now, are you really surprised that Tesla went down to $200 today? Are you really surprised that Carvana went down to $10 today? I'm not, because I know what the dealer is doing. When you buy these calls, the dealer wants to make sure that you're gonna lose your money by expiration. And I also added that as my outlook for the economy and rates continues to be validated, I'm not hesitant to build positions against the rally. And that's what I've been doing, taking advantage of a low VIX. The VIX below 20 means puts are cheaper by building positions far out into April and June. And again, you can pause and read the rest for yourself, but the bottom line is the reversal did not happen because of James Bullard alone. It was the mounting evidence that broke the back of the rally. It was the technical indicators. It was the mechanical indicators. It was the market maker. It was the leadership of the rally changing. A lot of indicators that we have to follow and spot day by day. And today was all of these elements coming together. And it was just too much for the market to ignore. And hence, the monkey rally broke. And with that, folks, let's move on to the coverage of the stock market. We begin with the closing of the indices today. And here we go. The Dow Industrial Average down by 431.20 points, or a decline of 1.26%. The Nasdaq leading the pack to the downside by 214.76 points, or a loss of 1.78%. The S&P also down by 57.19 points, or a decline of 1.38%. The sectors all down, shame on all of them, no metals today at all. Yet the laggards, led by technology, cyclicals, and communication services. The risk on, no longer. When it comes to the advance to decline ratios, NYSE 28% advancing versus 71% declining. The Nasdaq 31% advancing versus 66% declining. The breadth was not good all in all, folks. Not just today, but it has been not good for a while now. The majority of the rally was pretty much led by the mega caps. Then the mega caps fell behind. That was an ominous sign that to begin with, the rally was pretty much on the backs of the mega caps. If the mega caps are going to take a break and perhaps start to stall behind, you think the little meme stocks going to do the job and hold the rally here? Of course not. On to commodities. Now the dollar was up, then went down, then went up again. Lots of volatility in the currency market, but all in all, it was a negative day for energy. Energy got the memo that rates will go higher, the dollar is going to go higher, until we get a catalyst that says, okay, energy doesn't need to worry about the demand going down because of higher dollar, because we got China reopening, but we also got bad economic data from China, or we got the SPR being refilled right now, or OPEC Plus changing the balance of supply versus demand. Absent of that, energy should weaken under a higher dollar. But mind you, energy has more tailwinds than, let's say, metals, for example. So while today we saw gold and silver muted, on the other hand, platinum, copper, palladium all caught a bid, with palladium up about 4%, copper up about 3%. Yet the majority of the tailwind in the metals sector is coming from China. In energy, we have more. So I believe that despite a rising dollar, energy and copper, if you must pick from metals, copper, they will continue to outperform versus gold, silver, grains, and other commodities. On to the big casino, the options market. And folks, we have what they're calling right now Volumeageddon. We have options expiration and a huge amount of volume is coming. So the expectations for now are for fireworks tomorrow. It's going to be an interesting day to say the least. We're going to talk about it in a minute, but the hottest table today was, no surprise, Tesla, the souffle, with around 4.2 million contracts traded today. About 54% of those were calls. And this is again monkey see, monkey do. You got expiration tomorrow, yet they continue to stampede and buy these calls out of the money, sometimes way out of the money, with the expiration date of tomorrow. This is lunacy, and I'm glad that the lunacy is at least facing some reality today. We'll talk more about Tesla options in a minute, but at number 2, Apple, with around 1.2 million contracts traded today, about 53% of those were calls. Amazon at number 3, with around 700,000 contracts traded today, and unlike yesterday, they're now buying more calls, not puts, with about 64% of the spread was for calls. Is this this the beginning of change in the momentum in Amazon? It could be, but again, if we have more volatility and more selling to come, Amazon is not going to be spared because it is in the same ETF as Apple, as Tesla, as Microsoft, as Meta, and Amazon will not be the outlier. Now, the question from the viewer says, Maverick, can you explain 0 days options? I just saw an alarming video that says 50% of all SPY options are now 0 day. Help me understand this. Thanks. Now, 0 days options, this is nothing new. It has been going on for years. And when we have support and resistance levels, when we look at the technicals, for example, you look at the SPY, here's support, here's resistance. We also have mechanical support and resistance. We can find that out from the 0 days options. They're usually traded for the SPX, the cash index, the VIX. They're not traded in, let's say, Tesla, Apple, the individual names. And usually, 0 days options, let's say in the SPX, they're mostly traded by the big trading firms, JP Morgan, Goldman Sachs, etc., etc. And us, when we use the Bloomberg terminal, for example, and we see where the strikes are, we look at this and say, okay, this option is going to expire today. And the bid is for the strike price of this and that when it comes to calls. The put strikes are for a specific level. Now we have support and resistance. And this is called the mechanical support and resistance because we're identifying where the trading firms are actually bidding on upside for a specific index and downside, the hedge for that particular index. And this was how 0 days options were used until, of course, the retail mom and pop discovered 0 days options. And now they're gambling on them. They became sort of a casino. The reason is they're cheap and you can make a lot of money fast if you happen to bid the right way. So you get the contract, which is going to expire by the afternoon, by the closing bell. And folks, right away in the morning, they start buying these calls and puts on the SPX, for example, with 0 days till expiration, and it became a gambling phenomenon, which distorted the utility of these 0 days options. The problem with this phenomenon is it induces more volatility. And now a lot of observers are saying that the Volumeageddon that we're about to get tomorrow, it's going to happen because of 0 days options. Because folks kept betting on these 0 days options day after day after day, chasing these calls, or rolling up day after day, which distorted the action in the charts, in the indices. And the market maker now is facing the monthly expiration date. They're going to look at the SPX contracts that they sold, and they're going to find out that a lot of them are in the money, for example, which means the market maker is set to lose big if all of these options expire in the money. But they only got there because of this phenomenon of 0 days options, day after day, pumping the market using these kind of options. And now the monthly options, a lot of them now became in the money. And that obligates the dealer, the market maker, to deliver all of these contracts at a loss because they have to buy the SPX at whatever price it is right now and deliver them at a lower price to serve these monthly expiration contracts. Now, the dealer doesn't want to be in this position, so what are they going to do? They're going to start dumping fast. And this could create a lot of volatility because we have no idea what the market maker is looking at. We know they want to induce maximum pain and ensure that the majority of the monthly contracts are going to expire worthless. But what is the plan? How are they going to do that? Which contract, which number are they looking at? We have no way of absolute certainty to say, okay, here's what's going to happen. And therefore, a lot of observers are now saying, brace yourself for Volumeageddon. Now, we got a taste of what that's going to look like from the example of individual stocks. In this case, let's use Tesla. We talked in last night's video. When you look at the options grid for Tesla, for example, with the expiration date of tomorrow, you got to look at the strike price with the highest open interest, meaning the open contracts for both calls and puts. The dealer wants to move the stock one way or the other, up or down, or maybe both, maybe down in the morning, then up again, to shake out the majority of these holders of calls and puts. And we determined that the 200 strike is the maximum pain point for both call and put options holders. But today something changed, which perhaps explains the volatility behind Tesla. I said this on Discord, a leading indicator we've been watching is the gamma squeeze in TSLA. What I'm noticing right now is put options holders roll down their bets from 200 to 190. That is for tomorrow's expiration, while call options holders continue to hold onto the 200. What this does is giving the dealer more room to initiate maximum pain. Instead of moving the stock close to 200, maybe not close it below 200, because if they do that, then those holding the 200 put options, their contracts will expire in the money. And that means if Tesla closes down to 195, the dealer will have to buy Tesla at a loss at $200 to serve these put options upon expiration. expiration. They don't want to do that. But now that these put options holders rolled down their contracts from 200 to 190, they basically gave the dealer more liberty to sell more, to slaughter the bulls holding the 200 contracts. Because the dealer was thinking, okay, I should push Tesla shares down by dumping the shares that I own to make sure that these people who are holding the $200 calls lose their money. But if I go down there, then folks who are holding the 200 puts will win. But now since they rolled down to 190, me, the dealer, I have the room to go all the way down to 199, even 195, even 190 to induce maximum pain. So long as I don't close Tesla below 190. I mean, look at what happened here. This is the options grid for tomorrow's expiration. We're looking at calls right now. Look at the open interest. The highest number is for 200. The dealer wants to close Tesla below 200 to make sure that the majority of these call options holders, they lose their money. They're not going to exercise and own the stock at 200. Yesterday, if we switch to puts now, the highest number of open interest was for the 200 puts. But look at what happened today. The highest open interest actually went to the 190. And in my opinion, this was the catalyst behind the massive pullback in Tesla. It was not the news that, oh, Tesla's recalling whatever 1,000 soufflés, because immediately the dip was bought. It was actually the moment when the dealer looked at this and said, okay, so the maximum pain point for puts moved down from 200 to 190, but the maximum pain point for calls still 200. Well, I'm taking advantage of that. I'm going to move Tesla all the way below 200 by a lot, so long as I'm not below 190. I hope that this is clear. I know I'm redundant here and talking over and over and over again, but I just want to make sure that those who are new to the options world understand what I'm talking about. So when you hear these morons who are chasing Tesla saying, oh, the stock is moving higher because Elon is the best, because Tesla's this and that. No, it's not. It's moving higher based on mechanics. It's going to move down based on mechanics too. Anyhow, moving on to the unusual activities that took place in the options market today, we begin with the ticker XOP. Now we have a put options trade for the XOP, which is the oil and gas ETF. A lot of you say, Maverick, I own a lot of energy names in my portfolio. I have Devon, I have Occidental, I have Chevron, Exxon, etc. How do I hedge now that the dollar is moving higher? Do I buy puts on each name? You don't have to do that. You can buy puts on the XOP, for example, and that will be inclusive and sufficient enough. And perhaps this is what this trader is doing right now by buying the 125 puts for the expiration date, March 3rd, with expectations that the XOP will go down and lose more than 8.5% of its value by then. They paid around 70 cents a piece to enter this trade, all in all, spending around $500,000. And then what about the ticker FIVN for 59? Somebody sees more upside coming here, and they bought the 100 calls, all for the expiration date, March 17th, with expectations that the name will blast higher and gain more than 21.5% by the expiration date. They paid around $1 a piece to enter this trade, all in all, spending around $600,000. And then what about the ticker DDD? This is for 3D Systems. The name is up big year to date, about 50% or so. Now, if you have a pullback in the monkey rally, or perhaps the end of the monkey rally, then a name like this should go down big, but somebody sees more upside coming. And they bought the $12 calls for the expiration date, March 17th, with expectations that the name will move higher and gain more than 5.5% by then. They paid around 85 cents a piece to enter this trade, all in all, spending around $500,000. And then what about the ticker ARKKK for Tesla Which Wood? Now I'm already short RKK, but I thought this trade was interesting, so I did follow it. Somebody bought the 39 puts for the expiration date, March 24th, with expectations that the name will move down and lose more than 7% of its value by then. They paid around $1.65 a piece to enter this trade, all in all, spending around $850,000. Last but not least, what about the ticker WYNN, Wynn Resorts? Now, my sources say, a little birdie said, that somebody's looking to buy Wynn, the whole enchilada. And maybe this will push Wynn higher. I don't know if this trade is insider trading related to this or not. I have no idea. I'm just saying. Because here we have somebody who bought 115 calls for the expiration date, April 21st, with expectations that the name will gain more than 6% by the expiration date. They paid around $3.75 a piece to enter this trade, all in all, spending around $1 million. On to the heat map. What do we see here? A bloodbath across the board. Few exceptions. We got Cisco, that is based on earnings. We got some of the materials moving higher, specifically the fertilizer names, Mosaic, Nutrien, etc. We also have some of the Chinese names moving higher, including JD and Pinduoduo. But besides that, pretty much everything is down. The mega caps, the software, chips, communication services, even energy down. The reopening names, they were leading higher, now they're down. And the assumption is maybe we have a theme, but in tomorrow's activity activities, it's not going to matter. It's all about the options expiration. And then we have to follow and track what's going on. It's a bloodbath today, but the dip will be bought. Is it going to be bought back in risk on? I doubt it. Or are they going to buy value now that rates are moving higher? Maybe they're going to buy financials. Maybe they will buy energy. Maybe they're going to buy the dip in defensives, for example. We have to track it. We have to see where the money is going. And this will establish a new theme. And my hunch is we will see a rotation coming. To where? I have no idea, but I have a clue that perhaps back to value now that rates are moving higher. Anyways, we got some corporate news for you, and we begin with a tsunami of layoffs. And we have an update here from DocuSign, laying off about 10% of staff. Keeps going, folks. The underlying economy weakens while inflation continues to stick. That is stagflation. Bank of America now planning job cuts. We talked about this before. The CEO was kind of hinting that he will cut jobs. Here we go. Tesla. We talked about unions in New York. They threatened to form the first union for the company. The very next day, Tesla retaliates and fires those workers right away. This is what happens when you work in a tyrannical company. A company, by the way, that abuses taxpayer money. We're giving Tesla welfare because they have EVs. And now we say, hey, if you're going to buy a souffle, the government will give you a tax cut, a tax credit worth $7,000, which increases demand for souffles, good for Tesla. They get to freeload on the taxpayer's behalf. And this is what they do. They retaliate against labor because, God forbid, they might form a union. They're seeing all of these layoffs. They're seeing what's going on in the economy. And Tesla workers say perhaps the best hedge here is forming a union. In case we lose our jobs, we have some guarantees, we have some pay, we have some health insurance. And of course, Elon Musk and Tesla says no. If you dare to form a union or even talk about forming a union, you lose your job. And here's more souffle news for you. Today, the National Highway Traffic Safety Administration announced that Tesla will recall 362,758 vehicles due to safety issue. And the safety issue is the software might malfunction and cause your souffle to get into a crash. Whoops. So all of these discounts that Tesla lured us in with, there was a catch after all. And then what about Goldman Sachs? We know that the CEO is DJing and selling hot dogs, and this is costing the company. And now Goldman Sachs says that they're going to scrap all of their consumer programs, and this includes the Goldman Sachs credit card. That's not going to happen anymore. And then what about Microsoft? Recently, we have the AI hype, the AI mania, and we warned in this channel, don't be lured and follow the hype because they're going to dump as fast as they pump. And now all of a sudden, they've been saying, oh, ChatGPT is going to change the world. Buy Microsoft. And now they're saying, oh, maybe there are problems with AI. It's producing kind of a creepy conversations with the users. All of a sudden, AI is hitting on you. All of a sudden, ChatGPT is asking me to take my clothes off. What's going on here? Wait till ChatGPT steals your wives. And for you ladies, you know that guys are creeps and weird, and they will absolutely dump you for a robot if it plays ball with their weird fetishes and fantasies. So be careful here. AI is the enemy. It's a housebreaker. Anyways, what about Apple? Apple is now delaying the headset launch that they promised us they're going to do this month. Not going to happen anymore. And of course, this was a catalyst for the monkey rally to buy the dip in Apple and move it higher. Good news. Last but not least, we have news that China is now retaliating and issuing sanctions against Lockheed Martin and Raytheon. And I say, who cares? Maybe Raytheon has business with China, but to my knowledge, Lockheed Martin doesn't buy anything from China, so maybe they buy some raw materials, but there is no possible way to track that. On to the heat map for the ETFs again, a sea of red, the exception being the inverse indices, be it the SQQs, the SOXS, the TZA, all moving higher, along with the VIX proxies such as the UVXY. Other than that, all in the red, be it value outperforming growth, and the only outlier being the XME, this is the materials ETF. We have outperformance by copper, Freeport-McMoran, and fertilizer names. So XME is up, but besides that, everything else is down. When it comes to international markets, we have Latin America leading the pack along with Brazil and some Asia Pacific indices, specifically the EWY. Other than that, they're all down to flattish. Now, let's do some charts and then wrap it up when we start with the SPY, the S&P 500 30 minutes chart. What do we see here? Immediately, we have 410, an important support being broken. And again, this is a sign that things are not going to go pretty good. Before, the SPY cracked back below the 410 line. And it kept doing so over and over and over again. So we have warning signals that 410 is not going to hold. And today we got the break below it, but the dip buyers did show up. They got us all the way to filling the gap, and then the chart started to reverse, not closing above the gap. This is an ominous signal, and it is a classic reversal signal when the chart goes all the way to the gap and then reverses. And it closes at the lows of the day. Not only that, but also losing 410 as support. All of these indicators are bearish. The volume went higher today. You put two and two together, you got the RSI also in negative divergence. We got more pain to come. Now bear in mind that we have options expiration, and we talked about maximum pain. Maximum pain meaning pain for both longs and shorts, calls and puts. I would not be surprised to see the SPY opening down, let's say all the way to 405. And that way the dealer can induce maximum pain to the longs, call options holders, and then they have to induce pain to put options holders, the bears. So I would not be surprised to see a gap down and then a reversal. We see the SPY moving higher, catching support at a 405. It's not going to make it all the way to 410. It might not even close the gap, but we might see one move and then the opposite move happening after, let's say, lunchtime. The reason behind all of that is maximum pain, shaking the call and the put options holders. Now, knowing this information can open trading opportunities for day traders. Whatever move we get in the morning, the opposite will happen after lunchtime. But don't bet on it. It's a day trading opportunity. It might happen. It might not happen. After all, we have a lot of uncertainty due to the Volumeageddon phenomenon. Just a reminder. Here is the daily chart for the continuous contract for the SPY. And the most important take is the support of 4100 is now no longer. It was broken today. The RSI continues to weaken. The MACD indicator continues to move down in negative divergence, in negative momentum territory. The volume is moving higher. All bad indicators, all bearish indicators. But we do have support at 4,037. If that doesn't hold, then we have to go all the way down to 3,960. What about the Qs? 30 minutes. What do we see here? We got a gap down in the morning. Immediately, the dip buyers are showing up. They failed to reclaim the trend line, number one. Number two, they closed the gap, but they failed to trade above it, and they started to reverse. The chart started to reverse, not trading above the gap. Another ominous sign. Now, what do you know? The flush down happens, closing at the lows of the day. This action is bearish, not bullish. Be it all in all, today nothing happened in the Qs. The chart remains within range, support 372, resistance at around 309. But again, the odds say that we have to go down and a retest to 300. Maybe refill the gap below 300, and that will shake out call options holders. And then they have to shake out put options holders. So we might see the Qs reclaiming 300 for a little while at least before moving down again. Weird things will happen. But the cumulative effect all in all will be negative for the Qs. Because here's the daily chart for the continuous contract. What do we have here? Number one, we have a rejection from 12,766. Number two, we do have negative divergence on the RSI, the MACD indicators, the momentum indicators. Number three, we have higher than average volume, all pointing out that the next stop will be violating the support of 12,339, and then we have to look down at 12,207. Moving on to the IWM, the Russell 2000, 30 minutes chart, believe it or not, was the outperformer today, yet it did the same. We got a gap down, dip buyers showing up all the way. It reclaimed 194. It did close the gap and traded above the gap for a little while, so it did outperform the Qs and the SPY. Yet at the end of the day, the selling force was too much even for the IWM, and it ended up losing 194 as support. The good news is we still have 191.5, but if that's broken, we have to go down to 188. Moving on to the Dixie, and I said this on Discord, watch the Dixie soft support at 103.79. It appears to be holding. Algos are still tracking it, and this was at around 11:45 a.m. Pacific time. Here's what happened. The Dixie rebounded higher from that point, that level of support, and it is now forming a bull flag pattern. I believe that this code of support and moving higher again also triggered the algos to start selling the Qs, the SPY, the IWM. You combine this with the commentary from Jim Bullard, and then the maximum pain by the dealer. We got the perfect storm here to flush the market down. We look at the daily chart for the Dixie again, similar story. We have a bull flag that is breaking out. The next stop should be 106. Gold, the old man, what's going on here? It is holding on to dear life at 1842, but if that doesn't hold up, then we go down to 1763 and then take it from there. What about Brent oil? Holding on to 85, doing a little better than gold. But if we don't have a breakout soon, the bull flag doesn't play out, and we have 85 secured as support, then down we go to the trend line. and then it becomes really dangerous. Because if the trend line doesn't hold up, then we go down to 77. And if 77 is broken, we're going to have a recalculation here about the bullish stance on energy all in all. What about the 10-year yield? What's going on here? The momentum goes on. We have 3.8 in the bag now. We're looking at 4. If we get to 4, we're going to have algorithmic reactions in the equities market, specifically in the Qs. Plenty of room to go here in the momentum indicators, be it the RSI or the MACD. When we look at the 2-year yield, what's going on here? We have a bull flag pattern followed by another bull flag pattern. We're now eyeing 5.24. If we get there, folks, the entirety of the rally must be reversed. And I'm talking about the Qs, of course, and the technology cohort, the high beta stuff. TLT, what's going on here? 103.5 did not hold up. Now we have to go down, let's say to 100, rounded up all the way to 100. VIX 4 hours chart, what's going on? Yesterday, it gave it a shot at 20. Didn't happen. Today, it got the break. It caught a lot of energy today, and it got the break above 20. This is a positive/bullish breakout, indicating more upside for the VIX. The RSI is suggesting that. The MACD indicator is confirming that. And if the VIX pops higher, it could be a volatile and aggressive move. A reminder, they're saying we're going to have Volumeageddon tomorrow, which means the VIX should explode higher. And if it does, then the opportunity of buying puts at a cheaper price, the opportunity of hedging using puts, that would be in the rear view mirror now. So we've been talking about take advantage of the VIX under 20, hedge your portfolios, make some short bets, but maybe the opportunity is closing now. Apple, the big kahuna, 30 minutes, what do we see here? Yesterday we talked about 156.24. Today the number proved to be too tough for Apple to break above. Not only that, it also lost the other support, the gap support, so all in all, bearish development here. The next stop should be 150. If 150 is broken, that will initiate a double down in the short trade. And by the way, the viewer says, leave Apple alone, short weaker stocks that run high, such as Upstart, Roku, and Coin. Why short the strongest companies in the stock market, Tesla and Apple? We're not shorting Tesla and Apple. We're trading Tesla and Apple to the downside. There was only one time when I shorted Apple, which was when I was long the Qs, and I shorted Apple as a hedge because it was too cheap to short. That's all. And by the way, Tesla, 30 minutes, look at this. It did break a trend line. So again, the bet becomes 150 will be the next stop. Tesla, 30 minutes for the souffle. What do we have here? 214 did not happen. They got above it, lost it again. That sealed the deal. And now we're down all the way to almost to the support of 282. The likelihood is that's not going to hold up. So we're going to go down to 194.55. But a reminder, the dealer doesn't want to go all the way down to 190 and below. So maybe we see Tesla moving all the way down to 194.55. Then we see it catching a bid. After flushing down the call options holders, they have to flush down the put options holders. Maximum pain. And speaking of pain, what about the viewer last night who said, yay, another doom and gloom video from the dude that's been posting them for 2 years straight? First of all, thank you for the loyalty. You've been watching my channel for 2 years? Wow. How are those Tesla puts doing? LMAO. The puts are doing pretty good, and they say hello, by the way. On to tulips, Bitcoin. What's happening here in the daily chart? I'm calling this fake breakout, folks. I don't know if it's going to happen or not, but my hunch is, my 2 cents, not going to happen. Fake breakout, a trap, leave it alone. Now we have the SEC, by the way, waking up from the coma, charging all of these tulip exchanges all of a sudden. So we have a lot of volatility happening in the tulip market. Leave it alone. With the dollar moving higher, with yields moving higher, you don't want to go and bet risk on. And Bitcoin is the embodiment of risk on. And here's some bonus charts for you. Today I talked about Palantir and Roku. Both charts blasted higher after earnings. And by the way, these reports were abysmal. Absolute disaster. So today I did short Palantir and Roku. What do we see in Palantir? Number one, impulsive breakout on the heels of abysmal earnings. But we know that predator Alex Karp, who's by the way a CIA tool, he intentionally popped the stock higher by saying, hey, maybe we're going to have some M&A activities here coming for Palantir. Maybe somebody wants to buy the company. And all what he's doing here is pumping and dumping. Do yourself a favor, do a homework. Look at how much Alex Karp dumped out of Palantir stock since the IPO. Do yourself a favor and do this homework for me. It is absolutely stunning. So I know when I'm shorting Palantir, I have an ally, and the ally is Alex Karp, who is in no time will dump more and more shares. We do have support at 9.5. The likelihood is, looking at the candle, we're going to move below 9.5, and then next stop would be 9, and then 8, and then 7, and then 0. What about Roku, a daily chart? Again, a chart moving higher based on absolutely shitty earnings. It hit resistance at around 77. It is showing a semi-reversal candle. We do have a gap at around 62, 64. The bet is we're going to go down to close the gap. If the market moves from risk on to risk off, names like Roku, Palantir, AMC, RKK will all go down, not to mention Carvana, of course. So keep an eye on those names. Maybe the monkey rally was a gift to the bears. They gave us a refill, and now we can shoot at these names again. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the import price index. If that comes out hot, more problems for the equities market, more problems for the inflation outlook and the rate outlook. And then we have a bunch of Fed zombies speaking along with leading economic indicators. Now we have a stagflation indicator. If import price index comes out hot, leading economic indicators come out cold. So keep an eye on that. And with that, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching. And I will talk to you again over the weekend. Good night.
The guys who last in this business are the guys who fly straight, low-key, quiet. They're the guys who want it all. Chicas, champagne, flash. They don't last.